Good morning, learners. Welcome to class. Today, our in lesson number 1 in my series of lessons. My lesson number 1, we're going to focus on introduction to the accounting equation, which is a very, very fundamental concept in accounting. Please pay attention. Are we ready? Please take out your books. Have everything ready? Alright, I think it seems like we are all ready. Let's get started. The general learning objectives of this lesson is for you to demonstrate an understanding of the accounting equation. Understanding. Specific learning objectives of the lesson: you must be able to state the accounting equation, to explain the elements of the accounting equation, to explain the relationships between the elements of the accounting equation, to explain the elements of financial position and its components, to relate the accounting equation to the statement of financial position, and to illustrate the effects with reasons, the effects of transactions on the elements of the accounting equation. What are those elements? We say the elements of the accounting equation, just to reiterate, is assets, capital, and liabilities. We'll get to those now. Alright, the accounting equation, we can explain this by two scenarios. The first scenario is where you have the resources in the business, which means the assets equals the resources supplied by the owner, which means here you look at this equation, one element is missing, that of what? Liabilities, because all the resources are supplied by the owner. Alright, this scenario is not common. You hardly find this in real life. So the second scenario is more common and it's practical. So scenario 2, the resources in the business equal the resources supplied by the owner and lenders. So the sources here of the supply, it's the owners and lenders. So in this scenario, your equation will look something like this. The assets will equal capital plus liabilities. Capital and liabilities will make up the assets. So the equation reads assets equals capital plus liabilities. So also from this, you can also derive another formula where you say capital would therefore be equal to assets minus liabilities. Capital is equal to assets minus liabilities. At the same time, therefore, also you can say liabilities equal assets minus capital. Capital is called the owner's equity. Liabilities is the total amount owed by the business, including loans. Right. Now, on the accounting equation, please note that the left-hand side of the equation, the question you are asking there is, what are the resources? The resources are assets of the business. And then on the right-hand side of the equation, the question being asked here is, who supplied the resources? If owners, then it is capital. If lenders, then it is liabilities. The question here is, who supplied the resources on the right hand side of the equation? So now, in a nutshell, really, the accounting equation represents the statement of financial position, or the balance sheet, as it were. The totals of transactions on the left side of the equation must equal the total of transactions on the right hand side of the equation. What does that mean? The equation, just to reiterate, the equation is assets equals capital plus liabilities. So if you take the assets on the left hand side as 100,000, the sum of the capital plus the liabilities on the right hand side must also be equal to 100,000. That's what it means. Normally, the left hand side of the equation is the assets and the right hand side of the equation is capital. Normally, it's capital and the liabilities. So which means this is now the normal or the general rule. So you can have a situation where you maybe want to determine capital, you want to determine liabilities, and that the equation will slightly change. But normally this is the situation. Total of the assets will always equal to total of capital plus liabilities. Just to reiterate what I said earlier, every transaction affects two items in the balance sheet. Okay, let's look at this scenario just to explain what I said. You have a situation, you have the three elements being assets, capital, and liabilities. Assets is represented by A, capital by C, liabilities by L. If C is equal to 6 and L is equal to 4, what is the value of A? The value of A is 10. Why? Capital plus liability, 6 plus 4 will give you 10. Second scenario, if A is equal to 15 and L is equal to 7, what is the value of C? The value of C is 8. Why? Because assets or minus liabilities, in this particular case, is 15 minus 7, that will give you 8. Lastly, if A is equal to 50,000 Namibia dollars and C is equal to 30,000 Namibia dollars, what is the value of L? The value of L is 20,000. Why? Because now you are saying liabilities equal to asset minus capital. So 50,000 minus 30,000 Namibia dollars, and that will give you 20,000. Just to have a look at what the balance sheet looks like. This is a horizontal balance sheet. The assets on the left hand side, as you can see, will be made up of non-current assets and current assets. The total of that will be your total asset. And the right hand side, you have capital and liabilities. Capital on top, and then have the liabilities, the two categories of liabilities, non-current and current liabilities, and that give you a total liabilities. So the capital plus the total liabilities will give you a total, and this total must agree to the total on the left hand side of this equation. Alright, let's look at some practical examples. If you buy goods on credit, what is the effect of that on the accounting equation? The assets will increase, inventory to be specific, and what? Because you are buying on credit, your liabilities will also increase. So your creditors will increase if not paid, and capital will not be affected in this case. Second example, buy goods by electronic funds transfer. Remember, we no longer have checks in this, so nowadays it's payments are by EFT. So what happens here? Only the asset, only the left hand side of the equation will be affected. On the one, you increase the asset, which is inventory, and you decrease another asset called bank. Remember, always two items will be affected. No effect on the capital, no effect on the liabilities. But now when you look at the net effect of these two, the one increase, the other one decrease, the net effect is 0. Pay creditors by EFT. What happens here? You decrease the assets, the bank, and capital will not be affected, but then you decrease that, the liabilities, by the same amount. So which means the left hand side of the equation and we increase by the same amount as what we decrease also by on the right hand side of the equation. So the total of the transactions on the left hand side equals the total of transactions on the right hand side of the equation. Lastly, if the owners pay more capital into the bank, what happens? You increase the asset, which is the bank, and that increase also the capital. Remember, resources supplied by the owners that will increase the capital. The liabilities will not be affected. So the net effect is that the left hand side will increase by the same amount, and the right hand side also will increase by the same amount. In conclusion, this lesson was just about introducing you to the accounting equation. What are the main points? Now, number one, the accounting equation is assets equals capital or liabilities plus I'm sorry, just repeat myself. Accounting equation is assets equals capital or equity plus liabilities. The total of each side of the balance sheet should always be equal to each other, the totals. And lastly, every transaction affects two items in the balance sheet or the statement of financial position. We have come to the end of our lesson today. Do you have any questions? John, do you have any question? I thought you were indicating no question. So it's all clear. Are we all clear on this one? Thank you very much for that. I thank you. Have a great day. We've come to the end of our lesson today. I hope you have enjoyed it and you have learned something for today.